I'm Jessica Minton for IB Times TV, reporting from the floor of the New York Stock Exchange, where stocks were little changed today after an increase in jobless claims just a week after falling to a 5-year low. But consumer spending was up in December, and incomes increased by the most in about 8 years. Jonathan Corpina from Meridian Equity Partners will weigh in about the latest mixed data and how an increase in taxes will affect consumer spending in the coming months. Wall Street inched lower on Thursday as economic data continued to paint a mixed picture of the economy. After the fiscal cliff crisis in Congress was avoided, many were expecting tax hikes just for the wealthy, but the expiration of a temporary payroll tax cut hit primarily middle and low-income consumers. As paychecks across the country have shrunk over the last month due to higher federal tax rates, there's concern that workers are already cutting back on spending, which will drag on the economy in 2013. Despite a surprise contraction in GDP in the fourth quarter, consumer spending was up in December. Will the increase in the payroll tax now pose as a hurdle to sustaining those gains in purchasing?
You know, that's an interesting question because I think we're still a little too soon into that to see the real effects of it. So in another quarter or so, we'll definitely start to see if the ripple effect is there. What's interesting is all this conflicting data that we're getting out of Washington. We come in some days, the economic data is good. We leave, the economic data is bad, and it's all how you interpret it. And also interesting enough is that it hasn't really affected the markets. Look at the way our markets have traded when any negative news out of Washington has occurred over the last 2 months. The market continues to move slowly higher and higher. So this just adds to the investor sentiment of not really sure what to do, but don't want to miss this upswing that we've seen in the market so far. We're getting to lofty levels, 5-year highs across the board, and investors still aren't convinced that it's the time to pull their money out of the market just yet. So we're going to need a couple of more rounds, a couple of more months of economic data to really see what the effects are on the new tax laws since January 1st and what we expect things to look like moving forward.
After Congress managed to avert the fiscal cliff, the Dow Jones Industrial Average is on track to have its best January since 1989. The Dow Jones Economic Sentiment Indicator increased to its highest reading since April 2012, and the gain in the ESI suggests growth is picking up in the first half of 2013, after the U.S. economy stalled in the fourth quarter. The Dow got off to a strong start in 2013. Will the diminishing fiscal cliff policies that are going on since the fiscal cliff was avoided and now the debt ceiling has been pushed back a few months, are investors more optimistic than they were a few months ago?
Fiscal cliff, no one talks about that anymore, and people have forgotten exactly what happened in the last 6 weeks of the year and the turmoil that we went through in anticipation of what was going to happen. It's a what have you done for me society that we're in right now. That's the past. I think everyone's looking at today and moving forward. We're looking at the unemployment number that's coming out tomorrow. We're way through earnings season. Everything seems positive from there. Yes, we do have another date on the calendar as far as the debt ceiling is concerned, but not really concerning people or alarming people right now at this point. The market seems like it wants to go higher. We're seeing a very natural progression of the market move higher, but yet we're not seeing any selling opportunities just yet. So what selling opportunities can there be? Really consistent negative economic indicators and data that comes out of Washington. We haven't seen a pattern of that. Earnings season, the forecast, the guidance moving forward hasn't really been too negative. It's been very cautious, but not negative. Headlines coming out of Europe, we haven't had any real market-moving headlines that have come out of Europe that has affected our markets like it did back in June, July, back in second, third quarter of last year. So right now, it just seems like the market's going to want to move higher. Investors are playing this very keen game of when they think this market is going to start to sell off. We have not started to see those signs just yet.
Thank you for joining us.
Thank you. Always a pleasure.
The jobless claims data released today was more than economists had predicted, setting us up for tomorrow's employment report. Analysts predict that the unemployment rate will stay at 7.8%. I'm Jessica Minton for IB Times TV.